welcome back to the Don and Gino Real Estate and Finance Show right here on your hometown station, AM 1220 KHTS.
And remember, our goal is always to guide you to personal and financial wellness. Welcome to the Don and Gino Real Estate and Finance Show on your hometown station, AM 1220 KHTS. Today, I'm joined by Steve Korn, a good friend of mine and co-host when Don is out. And thank you for joining us, buddy.
My pleasure, Gino. Glad to be here with everybody. Happy Saturday morning to you. And we're going to bring the best you need to know what's happening in Santa Cruz Valley.
All right. And just to invite you to our website, today's a little bit special. In honor of Halloween, I decided to keep my creepy mustache just for the show.
It took him so long to grow the dang thing, he's got to keep it on.
Well, I was Gomez Adams for the multiple Halloween events that we had, and I figured I would roll into this show with it. So check us out at donandgino.com. Go to the live streaming button, and you'll see I can kind of look into our crystal ball, because that's what we're going to talk about today, right, Steve?
That's it.
Talk a little bit about appreciation, and we'll talk a little bit about what's going on here in Santa Clarita as well.
And I'm just as your Saturday morning escrow officer, so here I am.
Well, I'm going to clean myself up here in the second segment and look a little more normal. So let's jump right in. I mean, the real estate market is still screaming hot, Steve. And there was a break there for a couple of weeks. You know, one of the things that we'll talk about some of the numbers, but one thing that can't be replaced is the feeling that you and I get by being in the market.
Yeah, that's true.
You know, open offers, offers being written, consumer sentiment locally. When I talk to people on the phone, do they feel excited? Do they feel like they want to wait? Do they feel like the market's overpriced? What are they talking about?
Multiple offers.
Yeah, you're still seeing multiple offer situations.
Big time.
How, and I know that these properties, as long as they're well priced, they're still flying off the market. In fact, had an agent I spoke to this weekend, had an open house, $700,000 price point, packed, just absolutely packed, nonstop. He said back to back to back to back to back, and that was in Saugus. So one of the things to consider is you've got resale competing against new construction. All the new construction has pretty much 1 to 2 HOAs and Mello-Roos. So Saugus is actually a pretty hot area right now, not having the Mello-Roos.
I had a conversation with a person yesterday who asked me that question, how's the market going? And I said, well, despite what you're hearing, as far as our low inventory, my numbers don't support that, because I found that a lot of the escrows that we're opening and closing aren't even hitting the MLS. They're not even statistics. They're properties that are going into escrow. They never got to the MLS. Therefore, time in the market is minimal. So right now, you're right. Market's screaming hot. Price point is changing, though. You mentioned to me that at that $700,000 sales price, they were packed. But my data shows, or has told me in the past, that that's just beyond the sweet spot of like 350 to 650 that are just flying off the shelf. Anything above 650 to say 800 was sitting around for a little while, still pretty aggressive. Anything over 900 was hanging out there for a little bit.
So let's talk about that for a minute, because that's a few things. I think that's one is that the consumer, the middle class, is doing well, and they've maybe been, now that the market's been doing well for some time, they've been able to save the necessary down payment, because it was down payment that was holding everybody back, not monthly payment. Monthly payment was fantastic, but for a long time, anything over 636 loan amount, which was our high balance conforming loan amount, you had to bring in dollar for dollar every down payment above that, right? So you're talking about those $700,000, $800,000 homes that people bringing in $100,000, $200,000 down payment. That's what was holding people back, not a $4,000 a month payment.
Right. I'm seeing a lot of people paying cash over $1 million too, Gino. Got a lot of people in escrow right now paying cash. Like, really? Cash for $1 million plus escrow? Come on. Right.
I know of a house that sold in River Village just recently for, I think, over $800,000, just cash. And it was money coming from the East Coast. So we got to remember that not everything happening here locally is because of what's happening around here locally. We're having people come live in Santa Clarita because it's one of the best places to live in the United States.
You can still get a great range of FHA purchasing power. So you got lots of properties that fit that range right now. That's still a great mortgage program for first-time home buyers or anybody else that's trying to get into the market that has limited down payment.
So let's talk a little bit about that, because I do think that that's one of the other drivers of the market. And if you're curious as to what's going to drive the market from here forward, it's 100%. It's going to be lending liquidity. And we're feeling it, we're seeing it. Non-prime is exploding. You're going to start seeing it in your loan docs. People paying upwards of somewhere between 5.5 and 6.5%.
Already have started to see it.
Yep. And those are nice middle-level loans, allowing self-employed borrowers to be more flexible so they don't have to rely on Fannie Mae and Freddie Mac. So the private lenders have entered the market in that space at a reasonable interest rate, not hard money rates, but you know, something between 5.5% and 6% feels okay now.
Well, those are the people that were previously paying cash. That now they say, well, you know, if I can get in the market for 5 or 6%, I'll keep my cash.
Well, especially if the stock market keeps doing what it's doing, right? Because they'll say, oh, 6% is great. I'm getting 22 in the stock market.
So we're seeing some higher liability properties going to escrow using those subprime,
non-prime, Steve, non-prime.
Reverse the sub word. Now it's non. we took the sub word off. It just erased out the English language. It no longer exists.
Well, but the truth of the matter is, even those loans today are still fairly safe. They're still being underwritten to bank statements. They're still being underwritten to something.
Rigorous underwriting.
However, and I'm going to bring this up early, I anticipate that by the middle to the end of next year, we will start to see some very loose lending standards. So we're starting to see and smell some of it. The first true stated loans have come back.
Really? Are you seeing 100% financing coming back?
We have 97 already, so really 100 is right there.
Yep.
So I don't know that we get to 100 anytime soon. I think what we change is how we underwrite so that it's more flexible. And it's been really, really difficult for the self-employed borrower. The way we underwrite the self-employed borrower is not fair. It really isn't. It's the way we underwrite a W-2 borrower is on their gross, and the way we underwrite a self-employed borrower is on the net. And so, you know, basically, if you're a conspiracy theorist, it's the government lenders saying if you don't pay taxes, you can't buy a house.
Well, it seems to not be deterring that many people because we got so many properties going to escrow in Santa Cruz Valley and beyond. You got some national statistics there that support a very aggressive market nationally, but keeping it close to home for now. You know, yeah, the inventory's low. We're still definitely needing more inventory than we have to sell right now. The demand certainly outpaces the market right now, and it has for a while, and it probably will continue. Prognosticators have already said that we're looking forward to the same market for the next 2 years, which I'm really looking forward to that. I think it's a healthy market as far as our appreciation rates. We're looking at a 4 to 6% appreciation rate year over year, which is healthy for our market, not the unfortunate appreciation rates of 16, 18, 20% that we saw before the crash.
Can't be sustained, right?
Understood.
It can't be sustained anywhere. If you have double-digit growth for any extended period of time, it's unsustainable. So you're right, especially in these areas like we're looking at here where the purchase prices are so high, you can't have double-digit appreciation. So, however, I will bring up a couple of those national numbers. We do see the 20-city index with CoreLogic came in at 5.9. And as Don and I have been talking about for a couple of years and we just discussed right now, that's a really solid appreciation rate for the top 20 metro areas. I hope that doesn't heat up too much. I think that's probably the upper end of the limit's going to be around 6.8. If we get anything above 7, then we're starting to create a little bit of an inflationary bubble.
The numbers to have locally, just to share with you listeners right now and watchers on the website, is we have a year-over-year increase of 5.3% for all properties. But interestingly enough, to break it down, in one-bedroom properties, we have a 5.4% increase year-over-year from last year this time to this year this time. Two-bedroom properties, a 7.7% increase. A three-bedroom property has a 6.7% increase, and a four-bedroom property has a 7.1% increase year over year. I'll share with you guys later on in the next segment some price points to go with those statistics, because you'll be surprised at the appreciation from 5 years ago to today. So let you know what our market's doing and doing healthily.
Perfect.
That's a new word, by the way.
Great time for healthily. I like that.
Healthily.
Well, great time for us to take a healthily break.
There you go.
And we'll be right back to the Don and Gino Real Estate and Finance Show.